The city is infected, not with a virus that attacks the lungs, but with something far more dangerous, one that infects decisions, spreads panic, and devours fortunes. In this city, people don't cough. They scream when their stocks plummet. They sweat when the markets rise too fast. They run, not from danger, but from their own shadow, from headlines, from ghosts they call the next crash. But there's one man, calm amidst the chaos. He walks slowly through the noise, immune, not because he's fearless, but because he understands the rules. He doesn't predict the panic, he survives it. His name was Benjamin Graham, the man Warren Buffett calls the second most influential person in my life, after my own father. But this story isn't about Graham or Buffett, it's about you. It's about whether you will survive this city or become another casualty of hype and herd. Because what you're about to discover isn't a method, it's a mental weapon. Graham didn't write for traders. He wrote for survivors, for those who knew that the greatest threat to your wealth isn't the next recession, it's your reaction to it. Imagine this. You walk into an elevator. There's a man beside you, sweating, eyes wide, whispering, "Sell, sell now. It's going to collapse." A second man steps in, calm, steady. He says, "When others lose their heads, that's when you keep yours." The doors close, and you have to choose, panic or principle. In this city, called the market, everyone wants to look like a genius. But the intelligent investor doesn't try to be clever. He tries to be consistent, safe, rational. And when the virus spreads, when media screams, friends beg, TikTok experts preach moonshots, he remembers the single rule that saved Graham, Buffett, and thousands more. Emotion kills wealth. In this video, we will enter that infected city, chapter by chapter. We will expose the lies, disarm the noise, and equip you with the one immunity the markets cannot destroy: clarity. Because in a world addicted to speed and speculation, you will learn to move slow and strike only when the odds are real, not emotional. This isn't a crash course. It's a survival story, your survival story. And when you reach the end, you won't just be an investor. You'll be one of the few who stayed sane in a city gone mad. The city is calling, and your guidebook starts now. Every morning, a man knocks on your door. He's unpredictable. Some days he's ecstatic, eyes gleaming, offering to buy everything you own at outrageous prices. Other days, he's gloomy, desperate to sell you the same things at a deep discount. He doesn't care what you say. He just shows up every single day. That man is Mr. Market. It sounds like a fairy tale or a psychology experiment, doesn't it? But it's not. It's the metaphor Benjamin Graham used to describe how the stock market behaves. Because behind every green candle and red ticker, there's a heartbeat. Not of logic, but of emotion. The market is not a god. It's not even a machine. It's a manic-depressive partner in your business of wealth. One day he's euphoric, shouting, "Everything is a bargain, buy now before it's too late." The next, he's muttering, "The sky is falling, nothing is worth holding." And yet, you believe him. Why? Because we're wired to respond to voices that shout louder than our own. When prices rise, we feel safer. When they fall, we feel stupid. But here's the paradox. Mr. Market is not there to guide you. He's there to be used by you. That's the core idea Graham hammered over and over again. The intelligent investor doesn't react to Mr. Market. He waits, watches. And when the manic seller shows up offering something valuable for half its worth, he buys, not because of hype, but because of value. When the euphoric buyer comes waving cash for something overpriced, he sells, not because he's scared, but because it's time. There's a story Graham never told explicitly, but it pulses behind his metaphor. It's the story of you, in the middle of a market storm. You check your phone. The portfolio is down 20%. You freeze. Mr. Market is screaming again. "Sell! Get out!" And deep down, a voice inside you whispers, maybe he's right. But what if, in that exact moment, you saw the drop as a clearance sale? What if, instead of fear, you felt calm? What if the storm was just a signal that your opportunity had arrived? That's what Graham was teaching, not just finance, but emotional discipline. Because Mr. Market doesn't ruin people. People ruin themselves by listening to him. So, the next time he knocks, remember this. You don't have to answer the door. Or, if you do, you don't have to believe him. You just have to ask one question. Is what I'm being offered worth more than the price? Nothing more, nothing less. And that is how you start to survive the city. one ignored knock at a time. He graduated atop of his class, MIT, finance, worked at a hedge fund that claimed it could predict everything. Algorithms, data lakes, sentiment analysis. He had it all. His friends called him a genius. But 5 years later, he was broke and broken. Why? Because being smart doesn't make you safe in the market. Sometimes it makes you arrogant. And arrogance is gasoline in a city already burning with emotion. Benjamin Graham was clear. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Notice what he didn't say. He didn't say the highest return. He didn't say predict the market. He didn't even say beat everyone else. He said safety and adequacy. But to the modern mind, trained on TikTok flexes and crypto-to-the-moon narratives, that sounds boring, too cautious, too slow. So we fall into the trap, believing we're smart enough to skip the fundamentals. We chase stories instead of substance, momentum instead of margin. Here's the truth. The market is not an IQ test. It's a test of emotional resilience. Graham's best students weren't necessarily the brightest. They were the most disciplined. Buffett once said, "Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get others into trouble." That's the core idea. Temperament over talent. Let's go back to our fallen genius. He knew the models. But when 2020 hit and stocks plummeted, his models screamed, rebalance, hold, be patient. But his gut screamed louder, get out! This is different. This is a collapse. So he sold. Then watched helplessly as the market recovered, doubled, and made everyone else rich, except him. Graham would say, that's not an investor. That's a speculator with a spreadsheet. And speculation, wrapped in academic language, is still gambling. Story time. In the 1970s, long-term capital management, run by Nobel Prize winners no less, bet the house on bond spreads. Their models were elegant, perfect, until they weren't. The result? A near collapse of the global financial system, saved only by a bailout. The lesson? Even rocket scientists can get blown up by emotional miscalculations disguised as precision. So, what does this mean for you? It means the real test isn't whether you know what a P/E ratio is. It's whether you can hold a declining stock that you know is undervalued, while everyone else calls you a fool. It means intelligence in investing is humility, patience, restraint, and the courage to say, I don't know what the market will do, but I know what I will do when it panics. Because panic is inevitable, and when it comes, when the sirens blare, the talking heads scream, sell, you must remember, you are not smarter than the market, but you can be more grounded. And that is true intelligence. Picture this. You're crossing a bridge suspended 500 feet above a roaring canyon. The bridge is made of wood, old and cracked. You weigh 150 pounds. The bridge, engineers say, can hold exactly 150 pounds. Would you cross it? Of course not. You'd want it to hold 300, maybe 500. You'd want breathing room, a buffer, a margin. That's the principle Graham called the margin of safety. Not just a smart idea, the idea. The golden rule that saved countless investors from ruin, and the one Warren Buffett called the 3 most important words in investing. It's not about being right. It's about not being destroyed when you're wrong, because you will be wrong. The margin of safety means never buy an investment at its full theoretical value. Always build in a cushion for error, for volatility, for the unexpected. If you think a company is worth $100 per share, you don't buy it at $99. You wait until it's 70 or 60, because that discount is your insurance against being human. Graham didn't invent this out of thin air. He lived it. After surviving the crash of 1929, he learned the hard way that even the best analysis couldn't predict the irrational behavior of the masses. So instead of predicting, he protected, by only buying when prices were absurdly in his favor. It's the same logic that drives engineers to overbuild bridges, or why a prudent climber checks every rope 3 times before ascending. When your life or your money is at stake, just enough is not enough. Let's talk real story. In 2008, Lehman Brothers fell. A financial apocalypse rippled across the globe. Stocks plunged, panic spread. But a small group of investors were not only safe, they thrived. Why? Because they had waited. They didn't chase during the boom. They didn't predict the top. They simply stayed in cash until great companies, strong, profitable, resilient, were selling at 50, 60, 70% below their intrinsic value. Then they moved in, quietly, calmly. And when the dust settled, they walked away with fortunes. That's the margin of safety in action. It's not sexy. It's not fast. It doesn't get you invited to CNBC or hyped on social media, but it works. Repeatedly, quietly, powerfully. Now, let's turn the mirror toward you. How many times have you bought a stock at its peak because you feared missing out? How many times have you chased hype, believing this time it's different? And how often have you paused, not to ask what you could gain, but what you might lose? Graham's wisdom is brutally simple. The intelligent investor doesn't swing at every pitch. He waits for the fat pitch, the one that's slow, low, and over the plate. He may stand there for months, even years, watching pitches fly by. But when his moment comes, he swings hard and rarely misses. So ask yourself now, what's your margin? In your investments, in your savings, even in your emotions? Because without one, you're not investing. You're gambling with no seatbelt. The market doesn't just move, it manipulates. Not like a magician pulling coins from your ear, but more like a mirror tilted just enough to distort what you see. And what you see is usually yourself, magnified and emotional. You think you're buying stocks, but what you're actually buying is a reflection of your fears, your hopes, your envy, and your past. Benjamin Graham understood something most investors still miss. The market is not neutral. It speaks in your language. It whispers what you already want to believe. When prices surge, it doesn't shout, "This is irrational." It whispers, "See, you were right. You're smarter than the rest." When prices fall, it doesn't warn, "This is a temporary dip." It whispers, "You're a fool. You missed the signal. Get out." And the cruelest part? The market tailors its whispers to you. If you're a cautious type, it convinces you to wait, right before the rise. If you're bold, it tempts you to double down, just before the crash. It's not just volatility, it's seduction. That's why Graham didn't just teach analysis. He taught awareness, awareness of self. Because if you don't know who you are, the market will decide for you. Let's paint a picture. It's April 2020, the world is locked down. The S&P has dropped 34%. Twitter is aflame with fear. Every news anchor looks like they haven't slept in weeks. Your portfolio bleeds red. Then a whisper, "Sell now, save what you can." You don't want to, but everyone else is doing it. You hit the button, relief, you feel smart, proactive. Then, the market roars back, and you realize you didn't save yourself. You sold your future at a discount, because fear whispered louder than facts. This isn't fiction. Millions did it. Millions still do, over and over. So, how do you escape this trap? By turning down the volume of the market and turning up the clarity within you. Graham's greatest tool wasn't a formula. It was self-inquiry. Why do I want to buy this? Am I reacting or responding? Am I investing based on value or emotion? Because the truth is, the market knows you better than you know it. And unless you separate yourself from its games, you become a character in its story, not the author of your own. This is why Graham divides investors into two types, the defensive and the enterprising. Not because one is smarter, but because each knows their own limits. The defensive investor embraces simplicity, index funds, patience, low turnover. He lets the market scream while he walks calmly forward. The enterprising investor hunts. He digs. He stays skeptical. But even then, he knows when to wait. The question is, which one are you? Are you letting the market tell you what to want? Or are you building a system that guards you from yourself? Because that's what Graham was really offering, a shield not just from the market, but from your own mind. Everybody wants to be the exception, the one who bought Bitcoin at $3, the genius who called the 2008 crash, the kid on Reddit who turned $1,000 into $1 million in 6 months. We hear these stories and something primal awakens. If they did it, I can too. But Graham would shake his head. Not because you dream too big, but because the market punishes those who treat it like a game of glory. Trying to be exceptional in the stock market is the most reliable way to fail. Why? Because when you chase outperformance, you change the rules. You stop being cautious. You stop being patient. You stop being rational. And the market devours that. Graham said it plainly. The investor's chief problem, and even his worst enemy, is likely to be himself. When you set out to beat the market, you no longer measure by sound decisions. You measure by comparison. And comparison leads to envy, and envy leads to action. Not thoughtful, strategic action, but emotional, twitchy, fear of missing out madness. Let's talk about the fund managers. Every quarter, they're judged against the S&P 500. If they underperform, investors pull out. If they take too little risk, they look timid. So, what do? They start swinging wildly, buying the hot sectors, doubling down on tech. And when the tide turns, they're the first to drown. Now imagine you're doing the same thing, chasing alpha, stock picking like you're in a casino dressed in financial vocabulary. You may win once, maybe twice. But like the gambler who can't leave the table after a lucky streak, your luck becomes a curse. You start to believe you're smarter than you are. That's when the trap closes. So, what's the alternative? Don't try to be the exception. Try to be the rule. Be the investor who accepts average market returns, knowing that average in the stock market over time is extraordinary. The S&P 500 has returned 9 to 10% annually for nearly a century. With compounding, that's enough to turn modest sums into massive fortunes. No prediction required, no ego stroking, just quiet, boring, unstoppable consistency. That's why Graham advised the defensive investor to own broad-based index funds, long before they were popular, not because it's lazy, but because it works. Because trying to be the best often means ignoring your best interests. Let's return to that city metaphor. Picture a rooftop. 100 investors are sprinting toward the edge, chasing a flying dollar bill in the wind. One grabs it and falls. The rest keep chasing, but one figure stands back, calm, holding a map, walking steadily, slowly, toward the bank vault that everyone else forgot was even there. That's you, if you choose to be, not the exception, but the one who survives. So, here's your mirror moment. Have you been chasing highs or building habits? Have you been trying to look smart or be safe? Because if you've fallen for the myth of exceptionalism, it's not too late to drop it. You don't need to beat the market. You need to not lose to yourself. A stock is trading at $80. News breaks, a lawsuit, a scandal, a CEO's divorce. Suddenly it crashes to $40. Panic spreads. Headlines scream. Friends message, "Did you sell?" But here's the question Benjamin Graham would ask. Did the value change or just the price? Most investors treat price as truth. If something falls, it must be bad. If it rises, it must be good. But that's not intelligence. That's obedience to a system designed to manipulate. Graham taught a different lens, one that separates the sizzle from the steak. Price is what you pay. Value is what you get. Let's break that down. Price is emotional. It changes second by second. It reflects mood swings, rumors, mass hysteria. Price is Mr. Market screaming outside your door. Value, on the other hand, is calm. It's rooted in fundamentals, assets, earnings, durability. It doesn't move when a celebrity tweets or a journalist panics. Value is what remains after the noise dies down. Graham's genius was reminding us that these two things are not twins. They're strangers who occasionally bump into each other, and then quickly go their separate ways. Think of it like this. You walk into a store. A coat priced at $1,000 is now marked down to $400. Has the coat changed? No. Just the perception of it. If the coat was well made, durable, stylish, its value is intact. Now, let's transfer that to investing. A great company, strong cash flow, long-term growth, ethical leadership may be selling at a 50% discount because of market panic. That's not a signal to flee. That's a flashing light. Opportunity. This is how Buffett, Graham's most famous disciple, built his fortune. He bought companies not because the price moved, but because the value was stable or growing even as the price dipped. He didn't care if the market was open the next day. He wasn't buying a ticker, he was buying a business. And so should you. Story theater time. During the 2000 dot-com crash, Amazon stock dropped from $113 to $6. Critics laughed. They're just selling books online, they scoffed. But the company's underlying model was sound. Revenue was growing. The customer base was loyal. The infrastructure was expanding. The price collapsed, but the value was quietly rising. Those who understood the difference, who bought while others mocked, became millionaires. This is the deep insight. If you can't detach price from value, you will always be a victim of volatility. But if you can make that mental split, if you can see price as an offer and not a verdict, you gain an edge no market can take away. And now it's time for reflection. When's the last time you sold something just because the price dropped? When's the last time you bought something just because it was rising? What if, instead, you trained yourself to ask, what is this actually worth, regardless of what others say? That question is your compass. It keeps you steady when storms hit, and it leads you to treasures others miss. Because in a city ruled by noise, the ability to hear signal is power. It begins with a whisper, a shift in tone, a few red candles, a rumor that spreads faster than truth. Then, the fall. Markets plunge, portfolios bleed, social media explodes with fear. The crash is here. And while most people panic, selling, screaming, scrambling, Benjamin Graham would lean back, steeple his fingers, and smile. Because for the intelligent investor, a market crash is not a tragedy. It's a test. It's also an opportunity in disguise. You see, most people misunderstand crashes. They think a crash is something that destroys value. But Graham knew better. A crash doesn't destroy value. It reveals it. Imagine walking through a forest after a fire. Trees are blackened, smoke lingers. At first it feels like devastation. But look closer. The fire has cleared the underbrush. What remains is the strong, the deep-rooted, the enduring. A market crash does the same. It burns away illusions, overpriced stocks, hollow hype, weak fundamentals. What's left behind are real businesses, durable assets, hidden gems covered in ash. But to see that, you need vision and courage, story time. In March 2020, the market dropped 34% in just 33 days, fastest crash in history. Airlines, oil, tech, everything plummeted. People said it was the end, but Graham-trained minds didn't flinch. They opened their notebooks, pulled up their value spreadsheets, looked for the strong companies being dragged down by panic. And while others were tweeting doomsday, they were buying future wealth on clearance. By the end of the year, the market not only recovered, it soared. And those who bought during the fire, they didn't just survive, they thrived. That's the beauty of the crash. It gives the patient investor what bull markets never can, a bargain. But here's the twist. This only works if you're prepared before the crash comes. You can't build discipline while drowning in fear. You build it now. You plan now. You write your rules before the panic blinds you. And then, when the crash hits, when your screen glows red, when every instinct screams, sell, you don't react. You respond. You remember Graham's quiet rule? The market is there to serve you, not to instruct you. So, when others flee, you lean in. Because you're not betting on sentiment. You're buying value. Because you're not chasing highs. You're harvesting lows. Because you're not part of the herd. You are the outlier who knows the crash is not the end. It's the beginning. Now pause. Have you ever looked at a crash and only seen chaos? Have you let fear override logic? What if, from now on, you saw every crash not as punishment, but as a window? A window into wealth, sanity, and real independence. Because the intelligent investor doesn't wait for peace to act. He prepares in calm so he can act in chaos. Imagine you're standing at a fork in the road. To the left, a quiet path. Smooth, steady, shaded. A few travelers walking slowly, eyes forward, hands in their pockets. No noise, no glory, but also no traps. To the right, a winding, noisy street. Neon lights, shouting vendors, charts everywhere. Crowds gather around blinking screens. This stock just doubled. Don't miss this trend! Excitement crackles in the air. Now, Graham walks beside you and whispers, pick one, but know this. Your survival depends not on where you walk, but how well you know yourself. This is the choice between the defensive investor and the enterprising investor, the two archetypes Graham believed every person must choose between. Not good versus bad, not strong versus weak, but honest versus delusional. The defensive investor is not lazy, he's intentional. He knows he doesn't have the time, or perhaps the temperament, to research individual companies, study balance sheets, track market shifts daily. So, he builds a fortress. A diversified, low-cost, passive portfolio. He invests in broad index funds, reinvests dividends, and tunes out the noise. He wins by not losing. He doesn't swing at every pitch. But over time, his patience and restraint compound into wealth far greater than most speculators ever taste. The enterprising investor, on the other hand, is active. He digs, he studies, he reads 10Ks like bedtime stories. But here's the key. He doesn't guess. He doesn't gamble. He acts only when he has a measurable edge, when the value is clear and the price is unjustifiably low. He's not a day trader. He's not chasing heat. He's a deep-sea diver, searching for pearls others miss. And yet, Graham warns, the danger lies not in choosing the wrong path, but in pretending you can walk both. Many fail here. They start defensively, indexing, steady, and then, during a market boom, greed whispers, why settle for average? They jump into speculative stocks, chase tips, abandon principles, and get crushed. The market doesn't punish arrogance immediately. It rewards it just long enough to make you overconfident. Then it pulls the rug. So this is your mirror moment. Who are you? Are you willing to commit to simplicity even when the world mocks you for being boring? Or are you prepared to do the real work, long nights, constant learning, deep analysis, to earn the right to be enterprising? Because this isn't just an investing strategy. It's a reflection of your emotional reality, your ability to say no, your willingness to wait, your discipline to act only when the odds favor you. There is no shame in being defensive. Buffett once said most people, even smart people, should be. Because being enterprising isn't about being more intelligent. It's about being more obsessive, more focused, more prepared for pain. Choose your path. Choose it early. Choose it before the market chooses for you. Because once you know who you are, the fog lifts. You stop reacting, you start responding, and you walk forward, eyes open, portfolio strong. He arrives uninvited, every morning, polished shoes, wide grin, briefcase filled with offers. Buy today, he says cheerfully. It's all going up. The next day he returns, same grin but now trembling hands. Sell now, it's all crashing. Meet Mr. Market. He is Graham's most enduring metaphor. Not a man of logic, but of moods. Not a guide, but a test. And the only way to survive him is to understand him. Imagine you own a private business. Every day your partner, Mr. Market, offers to buy your share or sell you his at different prices. One day he values the business at $1 million. The next, $600,000. The day after, $2 million. The catch? He doesn't care what the business is actually worth. His mood changes based on weather, rumors, Twitter, or nothing at all. Now, here's the key. You don't have to do anything. You can ignore him. Let him rant. Let him shout. And only when he offers something clearly in your favor, only then do you act. Graham's brilliance lies here. Instead of fearing volatility, he reframes it as opportunity. Volatility is not the enemy. It's the offer. Most investors get this backwards. They treat every price dip as a signal, every rally as truth. They believe Mr. Market's every whisper like gospel. But Mr. Market isn't wise. He's emotional, bipolar. He doesn't know the future. He doesn't even know the present, which is why your greatest power is your ability to ignore him. Story time. In 1999, Mr. Market was in a euphoric frenzy. .com stocks with no profits, no plans, no purpose were valued in the billions. Graham's teachings were mocked. Value investing is dead, they said. But those who listened to Mr. Market got crushed. Meanwhile, quiet investors, those who had learned to nod politely at Mr. Market and walk away, sat on cash. They waited. They endured mockery. And when the bubble burst, they stepped in, not with fear, but with confidence. Because they knew something others didn't. The louder Mr. Market gets, the more you should sit still. So, let's bring it back to you. How often have you felt the urge to do something just because prices moved? How many times have you reacted to Mr. Market's mood swings instead of your own logic? Graham's lesson is simple, but it requires deep discipline. Use Mr. Market. Don't follow him. You are not his employee. You are not his therapist. You are his master. He is there to serve you offers. You decide which to accept. So, the next time your portfolio drops and your screen flashes red, don't ask, what's happening? Ask instead, is this a good offer or a bad mood? Because if you can remember that, you are no longer at the mercy of the market. You are now the one holding the pen in this survival story. There's a quote often tossed around on finance blogs and Twitter threads. Rule number 1, don't lose money. Rule number 2, Don't forget rule number 1. But here's what most people miss. It's not about greed, it's about survival. Because in the world of investing, losing money isn't just painful, it's compounding in reverse. Benjamin Graham didn't promise riches. He promised resilience. He didn't build formulas for fantasy gains. He built shields, mental, strategic, and mathematical, that protect you when everything else falls apart. And his most underrated gift? A mindset that orbits one sacred idea: avoid permanent loss. Let's make this real. You invest $100,000, you lose 50%. Now you're at $50,000. To get back to where you started, you need a 100% return, not 50%. One mistake, one panic sell, one overpriced stock, and suddenly your journey isn't forward, it's uphill. That's why Graham's entire philosophy orbits around not getting wiped out. His strategy isn't about catching every gain, it's about building a fortress that can survive the storms. Because storms will come, recessions, crashes, pandemics, hype cycles. The question isn't if, it's when. And when they hit, your portfolio shouldn't need hope. It should already have armor. Here's what Graham prescribed: invest only when the value is far above the price. Diversify so no single failure can sink your ship. Avoid leverage unless you want to gamble with disaster. And never buy what you don't understand. It sounds simple, but it's rarely practiced. Why? Because in the chase for more, people forget to protect what they already have. Real story. In 2007, thousands of investors piled into mortgage-backed securities. The yields were great, the products were complex, the institutions pushing them had three-letter names and billion-dollar ads. But no one understood what was under the hood. When the engine blew, it wasn't just Wall Street that burned. It was retirees, teachers, families. People who thought risk meant volatility, not vaporization. Graham would have seen it coming, not because he had a crystal ball, but because he knew the formula. If you don't understand it, don't buy it. If the margin of safety isn't clear, walk away. If the loss can be permanent, the gain isn't worth it. Because protecting your capital is the only way to let time and compounding do their quiet magic. And now comes your mirror moment. Have you been playing offense without building a defense? Have you been seduced by shiny numbers without asking what could go wrong? Graham isn't asking you to be paranoid. He's asking you to be prepared, to build your wealth like a fortress, not a castle in the sky, to say no to short-term seductions, so you can say yes to long-term freedom. Because when you follow the don't lose money rule, you're not limiting your potential. You're protecting your possibility. You're saying, I'd rather be steadily wealthy than occasionally rich and often broke. If Benjamin Graham were alive today, would he be scrolling through stock charts at midnight, chasing hot tips on Reddit, or analyzing Tesla's PE ratio? No, he'd probably be sipping tea, quietly nodding at a Vanguard S&P 500 index fund. That's right. The father of value investing, the man who taught Buffett, who built a philosophy around analysis, margin of safety, and individual stock selection, would likely choose passive investing. And here's the paradox. Graham never once said you must pick stocks. What he said was this: the majority of people are better off with a simple, mechanical investment strategy that they can follow consistently. Let's break that down. Index funds aren't sexy. They don't spike overnight. They don't make headlines. But they work because they ride the long-term upward momentum of human productivity, economic growth, and innovation. Over the last century, the S&P 500 has returned around 10% per year on average. That means a simple monthly investment, dull, predictable, automated, beats 90% of actively managed funds over a 20-year period. Why? Because index funds eliminate the two deadliest investing diseases: emotional timing and overconfidence. When you invest in a broad-based index, you're not betting on Apple or Nvidia, you're betting on capitalism, on innovation, on human beings waking up every day to build, create, and compete. It's not just diversification, it's delegation to a system that, despite its hiccups and chaos, trends upward. Graham's students didn't all become stock-picking savants. Many of them, especially those without the time or temperament for deep research, became quiet millionaires by following this simple path: buy, hold, rebalance, repeat. Let me tell you a story. Sarah was a teacher in Ohio. She knew nothing about stocks, but she read a book, yes, Graham's, and something clicked. She didn't trust herself to pick winners, so she opened a low-cost index fund, contributed monthly, and ignored the noise. 25 years later, she retired with $1.2 million. No gambling, no guessing, just consistency. That's what Graham was really teaching. Invest in a way that protects you from yourself. And for most people, the easiest way to do that is to make investing boring. Because when investing is boring, life gets exciting. So why do people resist index funds? Because ego whispers, you're smarter than the average. Because greed says, you can do better. Because fear says, what if this isn't enough? But Graham would smile and say, being average in investing is actually exceptional, especially when average means 10% annual growth, tax efficiency, no emotional stress, and compounding peace of mind. So here's your mirror moment. Are you chasing thrill or building wealth? Are you trying to beat others or trying to protect your future? Because if you're not ready to dive deep into balance sheets, if you want to sleep peacefully, if you want to focus your life on something other than watching numbers flicker, index funds aren't a fallback. They're a fast track to freedom. It walks like strategy, talks like logic, wears the suit of sophistication. But make no mistake, it's speculation. And it's everywhere. In the morning news anchor who says, this could be the breakout year for biotech. In your coworker whispering, I heard this small cap AI stock is going 10x. Even in your own voice late at night, wondering if maybe, just this once, you should buy that thing that's about to explode. Benjamin Graham didn't hate speculation. He hated dishonesty. Not dishonesty to others, but to oneself. Because speculation, when acknowledged, is manageable. It's entertainment, a night at the casino with a clear limit. But when speculation pretends to be investing, it becomes lethal. Graham drew a hard line. An investment is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything else is speculation. So here's the question. How much of what you're doing is truly investing? Have you done the analysis? Do you understand the business? Is your principal safe? Or are you riding hope dressed as conviction? Let's tell a story. In the mid-2000s, a stock called Crocs, the quirky rubber shoe company, skyrocketed. Investors rushed in. Analysts called it the next Nike. At its peak, it seemed untouchable. Then the bottom fell out. The company hit supply chain issues, demand cooled, and the price collapsed. Many lost fortunes, not because Crocs was a scam, but because people weren't investing in Crocs. They were speculating on momentum. They hadn't asked, what's the value? What's the risk? They just saw green charts and jumped. Graham warned, the danger isn't the gamble. It's the gambler who thinks he's investing. That's why he urged investors to clearly separate their portfolio. A portion for true investment, anchored in analysis, protected by margin of safety. A separate smaller portion, if needed, for speculation, labeled clearly as such, handled with caution. Speculation is not the sin, self-deception is. Because when you lie to yourself about what you're doing, you lose the one thing Graham valued most, control. And in the market, control isn't about domination. It's about restraint. It's the voice that says, I don't have to chase. The hand that doesn't click buy just because a stock jumped 20% in 2 days. The mind that separates price action from business value. So here's your mirror moment. Where in your portfolio are you speculating, but calling it strategy? Where are you seeking thrill instead of return? Where have you silenced that small voice whispering, this doesn't feel safe? Graham would tell you, stop pretending. Be honest. Because when you label speculation for what it is, it loses its power. And when you protect the core of your portfolio from emotion, hype, and herd behavior, you win the game most never finish. Money isn't math, it's story. And every investor, whether they know it or not, carries a script inside their mind. A silent narrative about what wealth means, who deserves it, what risk looks like, and when it's too late. Benjamin Graham gave us tools, formulas, filters, philosophies. But behind it all was an invitation most people miss, to examine the stories we tell ourselves about money. Because no matter how rational we try to be, we invest through the lens of identity. Some people walk into the market carrying the story. I'm always behind. So they chase. They leap at every opportunity, afraid of missing the one shot. Others carry the story. I never win. So they sell early, or never buy at all. They sabotage success before it arrives. Some carry shame. I should have started earlier. Some carry pride, I'm smarter than the average, and some carry trauma, losing a business, watching their parents struggle, being burned in 2008 or 2020, and they turn every price dip into a battlefield. The market doesn't care about your story, but it will expose it, because money is emotional, and the market, like a mirror, reflects not your intelligence, but your beliefs. Graham understood this deeply. That's why he taught principles like margin of safety, long-term perspective, and emotional discipline, not as tactics, but as anchors against the tide of personal mythology. Story time. Alex, a first-generation college grad, grew up in a home where money was always scarce. Every dollar was a lifeline. So even after landing a solid job and building a stable portfolio, he couldn't hold on to risk. Every dip felt like danger. He pulled out of the market during COVID's crash, right before it bounced. Why? Not because of logic, but because his story said, safety first, always. It took him years to realize. The fear wasn't about finance. It was about childhood. Here's the deep insight. If you want to become an intelligent investor, you must first become an honest narrator. You must ask, what do I believe about wealth? Do I see investing as a tool or a test? Do I believe I'm worthy of abundance or just surviving? Because until you rewrite your story, the market will keep writing the ending for you. That's why Graham's work endures. Not because he made you rich, but because he made you aware. He gave you the permission to slow down, to ask questions, to disconnect from the hysteria and reconnect with principle. So now, your mirror moment, what story are you living? Is it one of panic or peace, of scarcity or strategy? What if, from now on, your narrative wasn't, I hope I win, but I know how to survive? Because the investors who survive long enough do win, not by predicting, but by staying in the game. His name never appeared on Forbes. He didn't wear designer suits or drive exotic cars. He was a janitor, lived in Vermont, drove a used pickup, ate lunch from a brown paper bag. When Ronald Read passed away in 2014, the world was stunned. He left behind over $8 million, mostly invested in dividend-paying stocks. Not because he won the lottery, not because he had insider tips, but because he followed the timeless blueprint laid out by Benjamin Graham. He bought value. He held for decades. He reinvested dividends. And most importantly, he never tried to be clever. Ronald Read was the living embodiment of what Graham called the defensive investor, a person who didn't seek the spotlight, only consistency. And his wealth wasn't an accident. It was engineered through boring excellence. While others rushed to trade the latest hot stocks, he quietly bought Coca-Cola, Procter & Gamble, Johnson & Johnson, companies with real earnings, strong fundamentals, and long-term stability. He didn't check the markets daily. He didn't panic in crashes. He didn't let Mr. Market's mood swings dictate his future. He lived, he worked, he saved, he invested, and he let time and compound interest do what they've done best since the beginning of capitalism: build wealth in silence. That's the part most people can't tolerate: silence. Most investors need noise, movement, action, drama. But Ronald Read didn't need the market to entertain him. He just needed it to function. And it did. Over and over again, through recessions and booms, war and peace, inflation and stagnation, his simple approach beat the frantic activity of hedge funds, traders, and would-be geniuses. Why does this story matter? Because it proves Graham's philosophy doesn't belong only to analysts or Ivy League MBAs. It belongs to anyone willing to follow principle over hype. To anyone brave enough to say, I'd rather be wealthy in 30 years than look wealthy for 30 seconds. To anyone who can master not just strategy, but self. Let's reflect. What would your portfolio look like if you stopped trying to outperform and simply stayed consistent? What if your edge wasn't information, but discipline? Because Ronald Read didn't have access to anything you don't. He just had a plan and the patience to trust it. That's what Graham was offering all along. A way for the ordinary to achieve the extraordinary through logic, not luck. They don't scream, they don't spike, they don't go viral, but they show up quietly, reliably, relentlessly, month after month, quarter after quarter, year after year. Dividends are the invisible engine of real wealth. While others chase chart patterns and speculate on which stock might go to the moon, the intelligent investor watches something far less flashy: cash flow. Benjamin Graham didn't obsess over the next 10x stock. He obsessed over consistency. And dividends? They're the heartbeat of consistency. Proof that a business not only earns, but shares. Let's break it down. A dividend is a company saying, we're profitable, we're stable, and we're confident enough in our future to pay you, our shareholder, a piece of it. It's not hype, it's habit. And over time, reinvested dividends can account for more than 40% of total stock market returns, sometimes more. That means a $10,000 investment in a solid dividend-paying index fund doesn't just grow from appreciation. It grows like a snowball rolling downhill, collecting layers of passive income. Here's where it gets even better. Dividends force a shift in mindset. When you own dividend-paying stocks, you stop staring at price charts. You start asking, is this company healthy? Are they still paying? Can I count on this income? It turns investing from a scoreboard into a stream. Story time. Susan, a retired nurse, started investing in her 30s. Nothing complicated. She picked dividend aristocrats, companies that not only paid dividends but raised them every year. Johnson & Johnson, Coca-Cola, Pepsi, McDonald's. She reinvested for 25 years. At retirement, her portfolio wasn't just big, it was self-feeding. Her dividends alone were generating $2,800 a month, more than enough to live on, without touching principal. She didn't win the lottery, she built a pipeline. That's what dividends are, a pipeline that eventually flows without effort, a form of income that doesn't depend on your time. And Graham loved this, because dividend-paying companies tend to be mature, disciplined, and resilient. Not always exciting, but dependable. They're the kind of businesses that keep going when the economy stumbles, that keep paying even during storms, that reward patience, not performance. But here's the trap. People ignore dividends because they seem small. Just 2% a year, that's nothing. But 2% becomes 2.5%, then 3%, then 4%. And when reinvested and compounded over decades, it becomes legacy. And here's your mirror moment. Are you chasing short-term sprints or building long-term streams? Do you want spikes or snowballs? Are you focused on how much you can flip or how much you can earn while you sleep? Because one of the most under-taught truths in investing is this. Price may fluctuate, but income compounds. And if you build a portfolio where the engine is income, not opinion, you step off the hamster wheel. You stop reacting, you start receiving. And when enough of those dividend checks come in, you realize something extraordinary. You're free. Greed doesn't arrive with a pitchfork. It shows up in a suit. It sounds like a helpful friend. You're doing great. Imagine if you just took a little more risk. It wears the smile of opportunity and the cologne of confidence. It nods when you check your growing portfolio and whispers, you could double this if you just move faster. And that's how it starts, not with a mistake, but with momentum. Benjamin Graham warned about this more than any other emotion. Greed is not just dangerous, it's seductive. It makes you believe you're not greedy, just ambitious, that you're not gambling, just optimizing. But underneath the language is a lack of limits. Because greed doesn't know enough. It doesn't stop when the income becomes passive. It doesn't celebrate a 10% return. It looks at your portfolio and says, why not 50%? And the moment you listen, truly listen, you stop being an investor. You become a chaser. Graham understood the cycle well. First comes safety, then comes success, then comes confidence, then, inevitably, overreach. You increase position sizes, you cut corners, you stop double-checking value, you start rationalizing inflated prices. You become everything you once warned yourself not to be. Story time. In the early 2000s, a quiet investor named Peter had done well with a simple Graham-style approach. Value stocks, dividend reinvestment, a long-term view. By 2006, his net worth had passed $800,000. Then he saw others getting rich in real estate, flipping properties with borrowed money. He told himself, I'm not being greedy, I'm diversifying. By 2009, he had lost half his net worth, not because he was dumb, but because he abandoned his core philosophy in pursuit of more. Greed doesn't destroy with fire, it corrodes with logic, and that's the real danger. It dresses up as strategy. So, how do you defend yourself? Graham gave the answer, though many overlook it. Humility and boundaries. Have rules, fixed percentages, maximum allocations. Decide in advance how much risk is too much. Lock your investment policy in writing, so when the seduction of more whispers, you already have an answer. And more than that, define enough. What does financial freedom look like for you? Because if you don't define it, greed will, and it will always move the target. Here's your mirror moment. Are your goals clear or constantly inflating? Are your decisions grounded or drifting with the market winds? Have you made peace with slow gains, or are you still chasing glory? Because the investor who survives isn't the one who makes the most. It's the one who needs the least. And when you kill greed, not with force, but with clarity, you create space for gratitude, discipline, and legacy. It starts in your chest, tight, quiet, a weight you can't name. You check your portfolio, red everywhere. Your hands hover over the sell button. You scroll through headlines, layoffs, crashes, bank failures, recession imminent. Your brain knows you planned for this, but your body is screaming. Fear doesn't ask for permission. It hijacks your operating system. And in investing, fear is far more dangerous than any external threat because it comes from within. Benjamin Graham understood this intimately. He watched empires crumble not because they lacked capital, but because they lacked calm. He watched investors who studied for years abandon their strategy in 1 hour of market panic. Fear doesn't shout. It whispers. It says, what if this time really is different? It says, maybe this is just the beginning of the collapse. It says, you're smarter than those who stay in. Get out while you can. And that's how decades of discipline can be wiped away in a moment of doubt. Story Theater, March 2009. The S&P 500 hits its lowest point since the crash began. Markets have lost over 50% in value. The media calls it the end of retirement. Bob, a 63-year-old engineer, had followed Graham's principles for years. Diversified portfolio, dividend stocks, moderate risk. But that week, he broke. He sold everything. 2 weeks later, the market began its strongest bull run in decades. Bob didn't get back in until 2014. He missed the recovery. He missed the compounding. He missed his plan, not because of error, because of emotion. Here's the thing Graham knew. You can't eliminate fear, but you can prepare for it. You can build a strategy that assumes panic will come and gives your rational mind the tools to take the wheel back. How? First, systematize your decisions. Have pre-written rules for rebalancing, for buying dips, for when to hold. When panic hits, read your plan, not your feelings. Second, zoom out. Look at a 100-year chart of the market. Crashes come, crashes go, but the long-term trend, when you buy value and hold, is up. Third, accept fear as normal. Fear isn't failure. Acting on fear is. Graham would often say that volatility is the price you pay for participation, not punishment, tuition. So here's your mirror moment. How do you react when your screen glows red? Do you have a process, or do you have panic? Are you grounded in principles, or at the mercy of predictions? Fear is not a sign you're weak. It's a sign you're human. But building systems, checklists, and philosophies, that's how you protect your future from your present emotions. Because investing isn't about avoiding storms. It's about building a vessel that holds steady through them. And when fear crashes like a wave, you'll be the one who stands. He didn't carry a magnifying glass. He didn't wear a trench coat. But Benjamin Graham was a detective, one who hunted for mispriced businesses the way Sherlock Holmes searched for hidden clues. Where others saw tickers, Graham saw stories. Where others chased trends, he chased value. And his method? Ruthless in logic, simple in appearance, devastatingly effective over time. Welcome to value screening, the art of identifying what's really worth owning. Graham believed that behind every stock is a business, not a bet, not a vibe, a real company selling real things to real people. So he developed a checklist, a system of filters to separate the solid from the shiny. And at the heart of it all, one simple principle: buy $1 for 50 cents. Let's break down how he found those 50-cent dollars. First, earnings stability. Graham wanted companies that had shown consistent profits for at least 10 years, not one-hit wonders, not hype-fueled startups, but proven machines of revenue. Second, strong balance sheets. Assets should outweigh liabilities. Debt shouldn't be a ticking time bomb. Cash flow should be healthy. Graham didn't want drama, he wanted durability. Third, low price-to-earnings ratios. If the average market PE was 15, he was looking for businesses trading at 10 or below. That meant he wasn't paying top dollar for growth hype. He was buying overlooked strength. Fourth, dividends. Not only as a sign of profitability, but as proof that the company respected shareholders. Dividends were a kind of financial fingerprint, evidence of financial maturity. Fifth, margin of safety. Graham only acted when the gap between a company's intrinsic value and its market price was undeniable. He wanted a cushion, an error-proof zone, a discount big enough that even if his estimates were off, he'd still come out ahead. Story time. In the 1940s, Graham invested in a company that made vacuum tubes, Northern Pipeline. Not exactly sexy. But he noticed something odd. The company held a massive amount of cash and government bonds. In fact, its assets were worth more than its stock price. Graham didn't need to predict growth. He didn't care about buzz. The numbers told the story. He bought quietly, patiently, and when the market finally caught on, he sold for a handsome profit. That's what value screening is, finding the overlooked, the unloved, the undervalued, and acting when no one else dares to look. It's not glamorous, it's not fast, it doesn't make headlines, but it builds real wealth. And today, with modern tools, Graham's process is even easier to apply. You can screen for low PE ratios. You can scan for balance sheet strength. You can filter for dividend payers. The question is not how. The question is, will you? Will you train your eyes to see value where others see noise? Will you slow down when the crowd speeds up? Will you dig deeper than the headline? Here's your mirror moment. Are you reacting to what's popular or investigating what's real? Because when you become a value detective, you stop gambling, you start building. And every company you buy becomes a clue, a piece of a much bigger mystery, your long-term wealth story. The graphs are green, the numbers rise, your account balance jumps. Friends ask for advice, strangers like your posts. You feel it in your chest, that dangerous little buzz, I'm good at this. But Benjamin Graham would raise an eyebrow and ask, are you? Because success in the market is a lot like walking through a casino with your pockets full. You may have walked out richer, but was it your skill, or was it luck dressed in confidence? Graham didn't just warn against greed or fear, he warned against self-delusion, the tendency to mistake randomness for genius, the illusion that short-term success means long-term superiority. And this illusion, he argued, is deadlier than any market crash. Why? Because when you believe you're exceptional, you take risks the cautious person wouldn't even consider. You go all in. You stop checking value. You forget the margin of safety. You start thinking rules are for other people, and the market loves nothing more than to humble those who think they've figured it out. Here's the paradox Graham understood. The more convinced you are of your ability, the more danger you're in. Story time. In the mid-1990s, Julian Robertson ran one of the most successful hedge funds on earth, Tiger Management. He crushed markets for years, but by 2000, Robertson made one fatal mistake. He bet heavily against tech stocks at the wrong time. His logic was sound. The valuations were absurd, but his confidence made him act too soon, too big. Tiger collapsed, not because Julian wasn't smart, but because confidence outgrew caution. Graham taught the opposite. He said the intelligent investor always walks with a limp of humility, a quiet doubt in every conviction, a check on every assumption, a voice whispering, "What if I'm wrong?" And that doubt, that's not weakness, it's wisdom. It's what prevents you from betting the house. It's what makes you diversify. It's what reminds you to follow process over emotion, even when you're sure. Because the market doesn't reward bravado, it rewards resilience. So, let's reflect. Have you mistaken a bull run for brilliance? Have you thought, I'm different, when in truth, you just caught a wave? Are you building a system that works in any market, or one that only looks smart in the current one? Graham's core message here is this: temper your confidence with structure, trust in value, not in vision. Lean on timeless principles, not recent profits. And remember, the greatest investors in history don't talk about how smart they are. They talk about how often they're wrong, and how they survive those moments. It doesn't make headlines. It doesn't trend on finance Twitter. It doesn't feel exciting. But it is, without question, the most powerful force in investing. Time, not timing. Time. Benjamin Graham never claimed to know when markets would rise or fall. In fact, he mocked those who tried. He knew what most investors still resist. Trying to time the market is the fastest way to miss its magic. Because real wealth, enduring, compounding, life-changing wealth, doesn't come from genius moves. It comes from staying in the game long enough to let compounding do what compounding always does. Let's look at the math. Invest $10,000, earning an average 10% annual return. In 10 years, it grows to $26,000. Not bad. But wait, 20 years, $67,000. 30 years, $174,000. 40 years, $452,000. Same contribution, same return. The only variable is time. Time is the multiplier, the force multiplier, the cheat code. But here's the problem. People are impatient. They want results now. They want fast returns. They want validation in weeks, not decades. And so, they hop in and out. They sell when markets dip. They chase the next hot sector. They interrupt compounding before it can mature. Graham knew that behavior was the enemy of growth. He once wrote, "The investor's chief task is not to outsmart the market, but to outlast it. Because outlasting creates advantages no genius can replicate. You don't have to be early. You don't have to be perfect. You just have to stay." Story time. Anne started investing at 22, $200 a month. She didn't pick winners. She bought index funds. She never stopped, never pulled out during crashes, never chased hot trends. By age 62, she had over $1 million. Friend David waited until he was 40 to start investing. He put in more, double even, but by retirement, he had less. Why? Time. Anne didn't earn more. She just earned longer. Time quietly did the work. Here's the secret no one markets to you. Wealth is boring. It's repetition. It's delayed gratification. It's trusting that years of tiny decisions will someday explode into something massive. Graham didn't want you to guess. He wanted you to commit, to ride out the cycles, to let the dividends drip, to let the reinvestment stack, to let value rise while prices fluctuate. Because in the end, investing isn't a race. It's a relationship with time itself. Here's your mirror moment. Have you respected time or tried to cheat it? Have you held when others ran? Have you zoomed out, looked 10, 20, 30 years ahead, and built something that honors that timeline? Because if you haven't, start today. Not tomorrow, not when the market looks better. Today. Open the account, buy the index fund, make the first deposit. Because the most important investment decision isn't what you buy. It's when you start letting time go to work for you. Take a breath. You've walked through chaos. You've stared down greed, unmasked speculation, endured fear, and silenced the ego. You've met Mr. Market. You've seen the brilliance of boredom, the elegance of dividends, the unstoppable force of time. And now, you know. You know that investing isn't a gamble, or a thrill, or a flex. It's not a shortcut to glory or a badge of brilliance. It's a discipline, a craft, a quiet rebellion against the noise. And most of all, it's a commitment to yourself. Benjamin Graham didn't give us magic. He gave us mirrors. He handed you a blueprint, not just for building wealth, but for becoming the kind of person who deserves it. A person who doesn't panic in storms, who doesn't chase ghosts, who doesn't pretend to know the future, but instead builds slowly, watches carefully, acts deliberately. So, now, take inventory. Have you been investing with emotion or with intention? Have you been chasing wealth or building it? Have you been trying to beat the market or trying to outlast it? If this video changed the way you think, even just a little, drop a comment. Not for us, for you. Let this be your line in the sand, a public commitment to be the kind of investor Graham believed in. And share this with someone who's drowning in noise, someone who needs clarity, because the more people invest with wisdom, the less power fear and hype will have over all of us. Now remember this, you don't need to predict the future. You just need the courage to stay the course when others lose their way. That's what separates the intelligent investor from the emotional one. That's what builds legacy. That's what sets you apart. Welcome to the calm inside the chaos. Welcome to the next level of your financial life.